Ever wonder what a real market crash looks like from the inside? Well, today we're going to do just that. We're going to dissect a single brutal day, August 26th, 2025, to see exactly how a perfect storm of news, fear, and money can bring the market to its knees. Now, just a quick heads up, this is all for educational purposes, and we all know trading involves some serious risk. All right, let's get into it. 1.02%. Negative. After all the dust settled on August 26th, after all the chaos, the frantic buying, and even more frantic selling, this was the final verdict for India's benchmark Nifty 50 index. Just a number, right? But this number tells a story of pure, unfiltered panic. So the big question is, why? What happened? What kind of forces came together to trigger such a sudden, violent plunge? I mean, this wasn't just some slow drift downwards, this was a cliff. And to find the answer, you have to look way beyond the trading terminals in Mumbai. Yep, our story actually begins thousands of miles away in Washington, D.C. Because the primary catalyst, the single event that really lit the fuse on this whole thing, was a geopolitical shockwave that came disguised as a simple trade announcement. And here's the crucial shift that happened in everyone's minds that day. For weeks, the risk of higher tariffs, it was just background noise, right? Something investors were keeping an eye on. But on this day, that risk suddenly became a hard, cold certainty. And when something is certain, portfolio managers, they don't wait around. They act immediately. And this is why this dry, super official language from the U.S. Department of Homeland Security was the final nail in the coffin. Any hope for some last-minute deal, some diplomatic solution? Gone. The deadline was set. The time was specific. There was zero room left for speculation. This was real, and it was happening in a matter of hours. So, just how bad was it? Well, look at this. The U.S. wasn't just adding a tariff. They were slapping an additional 25% duty on top of an existing 25% duty. I mean, that effectively doubled the tariff rate to a staggering 50% on a huge chunk of Indian exports. This wasn't a warning shot. This was a direct economic hit. And here's what made the whole situation so much more dangerous for the markets. The justification wasn't about, unfair trade practices. It was explicitly tied to India's foreign policy, specifically its relationship with Russia and its oil purchases. So just like that, this thing blew up from a simple trade dispute into a full-blown geopolitical standoff. And those are not easy to solve. But here's the thing. That tariff news, as powerful as it was, it didn't act alone. Oh no, it was the spark that ignited a whole series of chain reactions, a cascade of selling that just started feeding on itself. So let's follow the dominoes as they fall. And this was the first major domino to go, the Indian rupee. It absolutely plunged against the US dollar, hitting a new record low of 87.78. Now, if you're a foreign investor, this is a massive red flag. Why? Simple. Every rupee your investment is worth is now worth less when you convert it back to your home currency. Your profits are literally evaporating. This is where things got really, really dangerous because a textbook negative feedback loop took hold. Think about it. The tariff news hits, which weakens the rupee. The weak rupee panics foreign investors, so they start selling stocks like crazy to get their money out. And this chart really shows you the battle lines that were drawn that day. On one side, you have the foreign institutional investors, the FIIs, just dumping everything, a massive 15,000 crore outflow of capital. On the other side, you've got the domestic institutions, the DIIs, buying with everything they had, trying to hold the line. But on this day, the foreign selling was it was a tidal wave. Okay, so with all this panic in the air, where did the money go? Because it always goes somewhere. Every market crash creates this really clear divide between what investors are desperately selling and where they are running to hide. And this was a classic flight to safety. The result? A sea of red. I mean, look at it. Banks, pharma, real estate, everything took a major hit. But in that ocean of red, there was one tiny green island, the Nifty FMCG index. These are the companies that sell stuff we use every day. Soap, food, you name it. In a storm, investors basically ran for the one sector they believed was completely stormproof. And make no mistake, this wasn't just a few big stocks dragging the market down. The pain was everywhere. An advanced decline ratio of 0.42 is just awful. It means that for every 2 stocks that managed to go up, nearly 5 went down. That is a broad-based capitulation. That is deep fear, plain and simple. And if you look at the day's biggest movers, it tells the exact same story. Who were the winners? Companies like Hindustan Unilever and Maruti Suzuki, companies focused on the Indian consumer. And the losers? Companies tied to global trade, like Tata Steel, or ones that are really sensitive to the economy, like Shriram Finance. The market drew a very, very clear line in the sand between what was considered safe and what was exposed. All right, so we've covered the fundamental why, we know the story, but what about the price action itself? The charts from that day paint a brutal, but very clear picture of the bears taking complete and total control. Let's break it down. This right here is the perfect anatomy of a technical breakdown. First, the day started with a gap down. That means there was overwhelming selling pressure before the market even opened. Then it just sliced through key technical support levels, like the 20 and 50-day moving averages, which almost certainly triggered a bunch of automated selling. The fear gauge, or VIX, went through the roof. And finally, the market closed right near its lowest point of the day, a classic sign that the sellers never ever let up. So when you put it all together, what does the anatomy of this crash really look like? Well, the US tariff was the main event, the big 50% driver, but it was massively amplified by the weak rupee and the FII selling that followed, each kicking in another 20% of the pressure. And all of this was happening against a backdrop of general global weakness. It was truly a perfect storm. And that really leaves us with one final critical question to think about. This crash wasn't caused by a bad earnings report or some change in interest rates. It was driven by a political decision made in another country thousands of miles away. As our world gets more and more interconnected, what does it mean for our investments when a single headline can wipe out billions in value overnight? Definitely something to think about. Thanks for tuning in.